Warren Buffett has stepped down as CEO of Berkshire Hathaway, and Greg Abel is taking the seat. That headline sounds dramatic, but the real story is more subtle. Berkshire is a system, not a personality. Some parts of the machine will keep running almost the same. Other parts will change quietly, especially the parts that involve capital allocation, communication, and expectations. In this video, I'm going to break down 7 things that are likely to change at Berkshire in 2026 and beyond, and 3 things that probably won't. This is educational, not financial advice. I'm not telling you what to buy or sell. I'm giving you a framework to understand what actually changes when a legendary CEO hands over the wheel. Before we get into the changes, you need one clear picture of what Berkshire really is. Berkshire isn't just a stock portfolio. It's a collection of major operating businesses, insurance, railroads, energy, manufacturing, retail, plus an investment portfolio, all tied together by one core activity, capital allocation. Berkshire takes cash from its businesses, especially insurance, and decides where that cash should go next. That, where the money goes, decision is the beating heart of Berkshire. So who is Greg Abel, and why does he matter? Greg Abel is not a public-facing celebrity investor. He's a long-time Berkshire operator who built influence inside the company over decades. He started his career at PricewaterhouseCoopers, then joined an energy company called Cal Energy in the early 1990s. That company evolved into MidAmerican Energy, and Berkshire bought control of MidAmerican in 1999. Abel rose through that organization, became CEO in 2008, and later led what is now Berkshire Hathaway Energy. That experience is important because energy and infrastructure force you to think in long-time horizons. You deal with regulation, massive capital projects, risk management, and steady compounding over years, not hype cycles. Then, in 2018, Abel was promoted to vice chairman overseeing Berkshire's non-insurance operations. That means he's been overseeing a huge portion of Berkshire's operating companies already. He's not walking into this blind. Now, even with that background, Abel is stepping into a different environment. Buffett wasn't just the CEO. He was the brand, the credibility, and the human symbol of discipline. Abel can run the business. The bigger question is whether the outside world lets him run it the way Berkshire is designed to be run. With that context, let's get into the 7 changes. First, the benefit of the doubt disappears, and that changes the pressure around decisions. Under Buffett, Berkshire lived in a rare zone. If Buffett sat on cash, investors called it patience. If he avoided deals, people assumed everything was overpriced. If he bought something big, sellers and shareholders believed there was a deep logic behind it. Abel doesn't inherit that reflexive trust on day one, because nobody does. And here's why this matters: perception creates pressure, and pressure changes behavior. There's a debate here. One side says Berkshire is so institutionalized that the CEO's personal aura doesn't matter anymore. The other side says aura matters because it affects the noise level, and the noise level affects whether leadership feels pushed to do something, to prove themselves. My view is simple. Abel doesn't need to be Buffett, but he does need time. The first year or 2 will be judged more emotionally than rationally, and that is a real change in the operating environment. Second, capital allocation will likely become more structured, and people argue about whether that's good or bad. Buffett's biggest competitive advantage was not just intelligence. It was speed and clarity. A deal comes in, he reads it, asks a few questions, and makes a call. Berkshire could be the easiest, yes, a seller ever got, because it wasn't trying to flip the business or micromanage it. Post-Buffett, institutions naturally add guardrails. Not necessarily because Abel can't decide, but because the organization wants decisions to be repeatable and defensible without one person's intuition. The debate is sharp. One camp loves structure. It reduces key person risk and lowers the chance of a huge mistake. The other camp worries structure is how you lose the Berkshire edge, because speed and certainty are part of the brand. What I expect is a middle path. Abel still makes big calls, but the process becomes more visible, more documented, and more institution-shaped. That can be healthy. but it can also make Berkshire feel less like a founder-led machine. Third, the cash mountain becomes the defining storyline, and the options are not as easy as they sound. Berkshire is sitting on an enormous cash pile, roughly in the $380 billion range. People call it a war chest, and it is. It gives Berkshire the ability to survive shocks and strike when others can't. But it's also a constraint. When you're that large, deploying cash at attractive returns becomes harder. Every option has trade-offs. If you hold cash, you may underperform in strong markets and attract criticism for being lazy. If you chase acquisitions, you risk overpaying. If you buy back shares aggressively, you risk doing it at prices that aren't truly attractive. If you start paying dividends, you permanently change Berkshire's identity and investor base. This is one of the most debated topics in the Berkshire world. Should Berkshire remain a cash first, discipline first machine, or should it adapt because the company's size makes classic Buffett-style deployment harder? Buffett was famously comfortable doing nothing when nothing was priced right. The real test is whether Berkshire keeps that muscle under new leadership, especially when the headlines get loud. Fourth, buybacks may become more market-sensitive, even if the philosophy stays the same. Buffett treated buybacks like a math problem: repurchase shares when they're meaningfully below intrinsic value, and only if it doesn't weaken the fortress balance sheet. After a transition, buybacks become more emotional in the eyes of investors. If the stock dips because people fear change, buybacks look like a confidence signal. If the stock holds up because people treat Berkshire as a safe harbor, buybacks become harder to justify. There's also a debate about messaging. Under Buffett, shareholders generally trusted buybacks weren't financial engineering. Under new leadership, some investors will push for buybacks as proof nothing changed, while others will be suspicious that buybacks are being used to manage optics. So the shift isn't, will Berkshire do buybacks? It's, how aggressively, under what conditions, and how will they communicate the rationale without sounding defensive? Fifth, acquisitions could change in style, more than in volume. Buffett's ideal acquisition was simple: buy a great business with a great manager, keep them, don't interfere, and let the cash flow compound. Abel's background is more operational, especially in energy and infrastructure. That can be a major advantage in capital-intensive businesses where execution and regulation matter. But it can also shift the center of gravity of the deals Berkshire prefers. Here's the debate: will Berkshire keep focusing on hands-off acquisitions, or will it lean more into platform-style deals where Berkshire's operating expertise plays a bigger role? If it leans too far into being hands-on, it risks diluting the Berkshire promise to sellers. We won't mess with your company. If it stays purely hands-off, it risks missing opportunities where operational integration is actually a competitive advantage. The likely outcome is gradual evolution, not a sudden pivot. But even gradual evolution counts as a real change. Sixth, the public stock portfolio becomes more team visible, and the scrutiny gets louder. Berkshire's investing has already been partially delegated for years. That's not new. What changes is how every move gets interpreted. When Buffett was CEO, the market treated many decisions as Buffett's philosophy in action. After Buffett, portfolio changes will be framed as signals about the new era. Is this Abel's Berkshire? Is the investing team taking more influence? Is the company changing its risk posture? That extra noise can matter because it can create pressure to explain decisions that were previously allowed to be quiet. There's also a deeper debate here. Is Berkshire's investing edge mostly Buffett, or is it the structure and patience of the institution? The answer is probably both. And the transition period is when that debate becomes loudest. Seventh, communication will shift, and that matters more than people admit. Buffett's shareholder communication was not just reporting. It was education, humility, and a clear philosophy. For many shareholders, the annual letter was part of the investment. After Buffett, even if the company remains disciplined, communication may become more formal, more corporate, and less personal. That doesn't mean it will become worse. But it does change the shareholder relationship, and Berkshire has a shareholder base that is unusually loyalty-driven. A lot of investors can handle bad quarters. What they can't handle is vague language, spin, and corporate fog. The job for the next era is not to imitate Buffett's voice, it's to keep Buffett's clarity. Now, those are 7 likely changes. Let's balance it with 3 things that probably won't change, because Berkshire's core design is bigger than any one CEO. First, the decentralized operating model is likely to remain. Berkshire buys businesses and lets strong managers run them. It doesn't centralize everything into a bureaucracy. It doesn't constantly reshuffle leadership. That is not a detail, it's the value proposition that makes Berkshire attractive to sellers and managers. Could there be tweaks? Sure. Every company evolves. But decentralization is deeply baked into Berkshire's reputation and incentives, so it's unlikely to be abandoned. Second, the fortress balance sheet mentality is likely to remain. Insurance sits under Berkshire's foundation, and insurance rewards survival thinking. Berkshire is designed to be strong on the worst day, not just look smart on the best day. That means liquidity, discipline, and an aversion to fragile leverage. This isn't a Buffett personality trait. It's a strategic requirement of the Berkshire model. Third, the long-term orientation is likely to persist. Berkshire does not run on a quarterly clock. The operating businesses are built for durability. The investor base expects patience. The culture respects restraint. Even if the media cycle gets louder during the transition, Berkshire's internal incentives still push toward long-term compounding over short-term theatrics. So what happens next? Rather than pretending to predict the future, here are 3 realistic scenarios for the next few years. Think of them as lanes on a highway. Scenario 1 is conservative continuity. Berkshire stays cautious. Cash stays high. Deals are rare. Buybacks happen only when valuation is clearly attractive. The company looks boring, steady, and resilient. The trade-off is that some investors complain that Berkshire is doing nothing, even though restraint may be the rational choice. Scenario 2 is the base case evolution. The culture stays the same, but the decision-making becomes more visible. Capital allocation becomes slightly more structured. You see disciplined buybacks, occasional acquisitions that fit Berkshire's style, and clearer delegation of responsibilities. Berkshire remains Berkshire, but the storytelling shifts from Buffett did X to the Berkshire system did X. Scenario 3 is the opportunistic strike. A major market dislocation creates real bargains. Berkshire deploys a meaningful amount of cash through a large acquisition, aggressive repurchases, or both. This is the scenario where people suddenly remember why Berkshire keeps a fortress balance sheet in the first place. Here's what to watch to figure out which scenario you're in. Watch the cash level and the speed of change. Watch buyback activity and how they describe it. Watch for any major acquisition and whether it's hands-off or platform-like. Listen to how leadership talks about risk and liquidity. When a company's language changes, its behavior often changes next. And finally, here's a checklist you can use for any major CEO succession, not just Berkshire. Where does decision power actually move? One person to another, or one person to a committee? Who controls capital allocation, and what rules constrain them? What keeps the culture stable? Reputation, incentives, hiring, governance? What constraints are real? Debt, regulation, liquidity needs, cyclicality? And how do they communicate? Clear logic, or corporate fog? Buffett stepping down doesn't automatically mean Berkshire breaks. But it does mean Berkshire enters a new era where the same discipline has to be proven without the same legend attached to it. If you want to follow up, the obvious next one is this. The Cash Mountain Decision. The 4 ways Berkshire can deploy its cash, what each option signals, and which investor expectations each one disappoints. Subscribe for that, and comment one thing, which matters most to you in the post-Buffett era: capital allocation, buybacks, acquisitions, or communication?